This week, I'm going to show you the UK stocks I bought, the top riser and top faller in the portfolio, as well as the share tip of the week, which is a lower risk growth stock listed in the AIM markets. And if you enjoy the video, please try one of these to support the series. According to Google Finance, the FTSE 100 is up by 0.02%. The FTSE 250 is actually down by minus 2.79%, and the S&P 500 is roughly down 1%. My portfolio has managed to relatively keep up with the markets by only dropping by minus 0.82%. Although I believe I've made some changes over this last week that may have added to the volatility and perhaps led to me actually underperforming. However, this week marks the first £100 I've received in dividend income, which is since I started in April, which means in 8 months I've made £100 of dividends, which is really quite impressive when my portfolio yield is only around 0.8%. And my highest yielding stock is like 2%, that's it. The three top topics of the week start in the US, and as you likely already know, Airbnb had IPO'd. If you don't know what an IPO is, it's basically them going public and listed on the markets. They were valuated at around $68 per share. However, the moment they got onto the markets, their share price had rocketed up to above $140, which would value them at a market cap of over $80 billion. Which in my mind doesn't make any sense whatsoever. And I think this is massively excessive for a company that's completely unprofitable and has reducing cash flow, which is already negative. In fact, I think investors are getting too eager for these US technology stocks. And whilst I don't think we will see a big tech bubble burst like we did in 2001, simply because interest rates are low, and it's not like we could just sell our technology stocks and lock in a yield of 6% when bonds are at like less than 1% yield. But I do believe that when the Fed start to reduce their balance sheet, these stocks are going to be hit quite hard, because stocks are IPOing in the US and doubling and tripling in value, and it just seems a bit ridiculous and too easy money. It seems like everyone is very much greedy in the markets. However, if you're invested in these typical technology stocks in the US, I'm going to say to be careful, because over the last 90 years, the S&P 500 has averaged annualized 9.8%. So whilst by all means enjoy your returns, there's only so far in the future these stocks can price, and therefore I think they may have limited returns once eventually that Fed balance sheet starts to disappear, or not disappear, but starts to reduce. In the UK, we've seen the fall of Arcadia, and we've seen that Frasers Group, or Mike Ashley, the owner of it, has definitely shown some interest, and this week it has been confirmed that he's very much interested in purchasing some of Arcadia's brands. In fact, their business had reported a rise in profits despite a fall in sales, and this was due to the business rates relief, which had benefited Mike Ashley's business, the Frasers Group. Furthermore, they've shown interest in Debenhams, in which they did try and offer that 50 mil lifeline loan. I believe this is from the top of my head, and they may have some interest in various brands like Topshop. And I think it's due to their strong financial position that they're willing to take the risk on this. Although I don't think I would be that comfortable as an investor if the business I was invested in was trying to acquire Arcadia's brands. And it really depends on how well Mike Ashley can recover these brands. And whilst I have faith that he likely can do this, and it will definitely be a stock I'm watching, I'm likely not going to buy. But it would be interesting to see how the high street holds up over the next few years. Ashtead Group had their first half of the financial year results announced in their trading update on Thursday. This is a rental business that provides various different industries such as construction, industrial, and also general equipment to these various sectors. And this is in the US, UK, and Canada. And this is actually the third largest position in my portfolio. They'd announced that their overall revenue was down by 3%, their rental revenues were down by 4%, but interestingly, their pre-tax profits were also down to £538 million from £778 million in 2019. But what gets really impressive here is exactly how much free cash flow they've managed to generate in this time of economic turmoil. And they've managed to get a record free cash flow of £822 million from £228 million in 2019. And that really shows how resilient and agile this business is despite their size and scale. And it's one of the reasons I remain long on the business, meaning that I plan to hold over the long term. And whilst I've not increased the position size in quite a while, this is because I'm waiting for the switch or the transition like we had seen with the vaccine news. I'm waiting for the growth stocks to then take the money and the value stocks to fall, and then I'm going to invest on that cyclical rotation and hopefully get a better value on my Hashtag Group shares. However, if they drop for any unforeseen reason, or I feel that there's not much value anyway, I'm likely going to invest in Hashtag Group as they are at a very low valuation for the quality of business that they are. And whilst yes, they didn't necessarily grow their dividend this year, I think that once they are in economic certainty, they are very much going to grow it, and likely faster than many other businesses. After all, this is a business that actually outperformed Amazon the last decade, and yet investors seem to not know of it. And you can get a free share worth up to £100 when you deposit just £1 if you sign up to Trading 212 using my link in the description down below or the promo code at the bottom left of the video. The top riser in the portfolio this week was actually Softcat, which was quite a surprise, although I had anticipated that there would have been some sort of rally up to their AGM earlier in the week. And by the looks of it, sentiment is once more rising. Its shares are up 7.18%, which I believe is actually the highest in the FTSE 350 out of all of the companies for this week. And you may be more surprised to hear that I'm actually cutting back on this position, and for a majority of it, I'd actually taken losses. And this is despite Softcat being awarded as Zoom's UK Partner of the Year. I still don't really like the industry. And as I mentioned last week, which if you're interested in that, I'll put a card at the top right of the video, but now I'm not as confident. I've managed to sell 50 shares of the stock, and I only have 50 shares left. But I've decided that I'd rather just cut my losses, or even perhaps take a small growth on the investment, which I might actually be doing, and then reinvest that elsewhere in the portfolio. Furthermore, they'd actually done their dividend or paid it for December, which is £26.36, which had pushed my total dividend to £101.73. I'm going to continue trimming this position back before they get caught in another cyclical trend, even if it means their share price goes to like £14. I don't mind. I'm just going to end that position and cut there. I've lost quite a lot of sentiment with this business, and no doubt I believe they will continue to do well, but would rather that money is invested elsewhere, in my own opinion, in better businesses. The top faller of the week comes after my thoughts on the overexcitement in the prior week. Last week, shares of Boohoo had rallied significantly over the potential acquisition, and people were just generally getting too hyped up. This week, shares have dropped by 5.5%, and it's just another reason to not really focus on the short-term noise whatsoever. I'm not so sure why the shares have dropped, and I'm not concerned at all. However, what I will say is that last week I did say that I would be purchasing more shares if it drops below £2.70 per share. However, I've now changed my mind on this, as I feel that I will be rather overexposed to this position. But what is quite impressive is the fact that I have a 46.8% allocation to Boohoo, and yet my portfolio only dropped by 0.8% considering Boohoo is down 5.5%. That really shows how resilient the other stocks in my portfolio are, and therefore I think I will only be purchasing more shares of Boohoo if it goes below my average price, as I don't want to go back into that position of being overexposed to Boohoo and their high volatility. And I'm beginning to believe that investor sentiment will likely remain low to the end of the calendar year, although I look forward to their trading update in January, because this is where they'll announce how well they did on Black Friday, which was promising based on the CEO's, the chairman's son on Twitter, and also how well they do over the Christmas period, in which I think high street stores are genuinely going to struggle. So I reckon this will be a winner in the next year, but I'm not going to get too greedy on this investment. I would rather build up my other positions and have a more balanced and diversified portfolio with a lot less systematic risk. Therefore, I think I will be more greedy if it drops below 2.4838 per share, and then I will likely be averaging down. This week I've actually bought two more businesses, and you'll likely already know if you're a regular viewer. Firstly, I bought Games Workshop, and this is because they are a fantastic company and my favourite UK company. And I've constantly thought that my position has been a bit smaller than I really want it to be, and arguably I could make it bigger than Boohoo if I really wanted. Since I had been selling a significant portion of Softcat, I mean I've cut the position by 50% the last week, that freed up a lot of capital, which I've been pushing into shares of Games Workshop, and recently they'd announced that they'd grown their dividend. 3 weeks ago I made a bold prediction, and what it shows is that I'm no magician, I can't predict this. I had estimated that they'd grow their quarter 3 dividend from 35 pence per share to 50 pence. Well, they had absolutely blown me away, and now they've grown it to 60 pence for the quarter 3 dividend. Furthermore, profits were 10 mil better than their expectations over a month ago. So this really is showing how strong of a business they are. Therefore, if the share price is going to remain stagnant, which it had done, I'm buying more shares. It seems foolish not to. And it does fall in line with their idea that they will reinvest truly surplus cash and put it into their dividend, which does mean it could be a very cyclical business, and in very economic struggling times, maybe a deep recession, and if they do poorly, it's likely they will cut or suspend the dividend. But I'm hoping that this may not happen and that they will continue to grow at their rate of growth. This week I bought an additional 6 shares of Games Workshop, which had heavily pushed up my average price, which I believe last week was around £84 and now it's around £87.31. And that brings my total to 46 shares of Games Workshop, and it's likely that as I finish to sell the rest of my Softcat position, that this position will also continue increasing, maybe up to 50, maybe more. The other stock I'd bought, and one that I'd been wanting to buy for a while but seen more value elsewhere, is Halma. And I've got a somewhat interesting story that whilst I was at work, and I was speaking to a customer and they were asking about my particular holdings, and I'd gone through all the depth of all of the businesses that I'd held and what I thought about them, although I realised that I didn't know Halma as well as I did, because when I was describing their business model, I was actually repeating Avon Rubber's business model, thinking they sold respiratory protection systems. And I mean, there's worse things to compare it to, but what it made me realise is that I really don't understand this investment. So this may be a stupid idea. I'm going to put more equity into this stock so that it pressures me to learn more or risk losing conviction. I've now learned that they operate and have different technology solutions in the health, safety and environmental areas, such as things like gas detection equipment and elevator safety systems. And I think this is such a broad business that is very ethically strong that I'm going to continue buying into it, even if their dividend growth is consistent but slower. And this week I've used the remaining profits or losses from Softcat and invested it into Halma, getting me an additional 6 shares. That's not 6, that's 8. 6 shares also. The share tip of the week is an interesting growth stock that I would consider to have lower risk, despite being in the less regulated, therefore widely assumed more risky AIM markets. This is a 5G stock that provides communication services and software services for businesses in the UK and internationally, albeit they are as complex as most telecommunications stocks truly are, so you do need to do a lot of research if you're interested in this one. This stock has had a consistent and very strong dividend growth, although they only currently yield 0.72%, but typically pay in June and October each year, which are, in my opinion, some rarer payment dates. Although the strong part about this business is their organic revenue growth over the last 5 years, which is absolutely fantastic. And whilst their earnings have also grown, they have been at a slower pace and haven't scaled with revenue, although I hope in the future they are able to do this. Furthermore, they have an excellent balance sheet in which their short-term assets completely outweigh their short-term liabilities and long-term liabilities, and they have 2% debt and a cash position that is massively much more than their debt. And over the last 5 years, shareholders had been rewarded by 248% with dividends reinvested returns. I think that's a truly capable growth stock, if not more safer and lower risk, especially considering the sector they're in. And I'm very tempted myself to buy this business and add it to my core positions, which are Halma, LSE and Ashted Group. Furthermore, this stock is named Gamma, or Gamma Communications, the ticker symbol GAMA, and I think now that they've been priced down in the last week by around 9%, they could be at a good value to buy and hold for the long term. And if you're interested in how to invest £1,000 here in the UK, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.